Welcome to Online Trading Campus and welcome to our OTC Futures course Module 2 Beginner. In Lesson 5, we will look into the life cycle characteristics. We will start this lesson with key terminology. After that, I will show you how to calculate rollover days, and I will spend some time focusing on the first notice day, which is one of the most important days you as a futures trader have to be aware of. At the end of the lesson, we will go through several life cycle examples of physical delivered and cash settled futures markets. So let's get started. There are some other terms we have to be aware about. Let's start with the least important one. First trading day, in short, FTD. That's simply the first day the contract is listed on the futures exchange. So basically the first day the contract is tradable. This is the day where the life cycle of the contract starts. A contract can be listed and start trading years before it eventually becomes front month. The first trading day has no implications to our trading. It's just for us to be aware of. So now please listen carefully. This becomes really important. If you're trading a futures contract that is physically delivered, they will all have something called a first notice day. In short, FND. This is the day that any trader wishing to make or take delivery of the particular commodity contract must notify the exchange of their intent. In other words, if I still hold the contract on that day, the first notice day, buy or sell contract, on that day I declare to purchase or sell a physical commodity. As a speculator, you do not want to be trading after this day in that contract. TradeStation will not allow you to trade beyond this date due to the risk of delivery assignment. Today deliveries on expiring futures contracts only occur about 2% of the time. The other 98% are offset before the futures contract expires. Being long a contract after this date is telling the exchange you want to take delivery of that commodity, and the delivery will most likely be assigned to you. This information is important to the trader charting a commodity futures contract, because everybody but people interested in the delivery process will have left this contract by the FND that tells you the rollover date for that commodity. That is half of the equation, the FND. The next date you will need is the last trading day, the LTD. It's the same as expiration date. We explored this day in the previous lesson. This is the date the contract actually expires and will not trade anymore for that month and year. Now you should be able to see what two dates we will need to determine chart settings for an unadjusted chart. We will take the LTD and FND to determine how many days the contract should roll over before expiration. You're probably wondering where you get the information of a commodity futures contract's FND or LTD. There are many calendars on the internet and the exchanges will list them on their calendars too. One drawback to using an exchange calendar is that you only see listed the products that trade on that exchange. Here's a link to a website that lists all of the notice days you will need. It's www.insidefutures.com/calendar/index.php. Looking at this calendar, let's find the 10-year Treasury, the TY, contracts FND and LTD. If you look at February 28th, you will see that the Treasury complex has FND for the March contract that day. This means that the majority of volume will be gone from the March contract on the first trading day of March. The front month will then become June 2020. The next thing you need to find is when does the March TY expire. We scroll forward to March on the calendar and we find that on March 20th the March TY will expire. Now we simply count from March 20th back to February 28th and you're only to count trading days. We see there are 14 trading days between these two dates. Another note here about contract rollovers. In this example of the TY, we see exactly 14 trading days. During the previous contract rollover, there were 15 days and sometimes there are 13 days. This is very typical of the futures market. Sometimes there are holidays, positions need an extra or one day less to roll over. What we will do is just take an average for these rollovers, and the most you will be off is a day, maybe 2 days. The average cycle for the CME interest rate products is 14 days. With this information, we can now create an unadjusted continuous contract that will roll over 14 days before every contract expiration. On your TradeStation chart or radar screen, you can enter the symbol at TY equals 114XN. As I mentioned earlier, each futures contract will roll over at different times before each expiration. It is a good idea to go through the markets you will be trading and create a list of these expiration dates so you can create charts that more closely represent contract month with the most volume. We will do this together in the practical application session after this module, so you know how to do this in the future by yourself. On the radar screen in TradeStation, we can also add FND, as you can see here. Now we have both important dates next to each other, LTD and FND. Again, please note that first notice day is not the same as expiration date / last trading day. Now you can also clearly recognize that for the financial futures, such as the equity index group and the currency group, you don't have physical delivery. In markets where there is no physical delivery, the position must be closed prior to the expiration date / last trading day. Let's look at 3 different life cycle scenarios of futures markets. Let's start with scenario 1. As an example, the gold market only requires an initial margin of $5,500 to trade one contract of 100 ounces of gold. Remember, that's the contract unit. Let's say one contract is currently worth $1,600 per ounce. That means the notional value of that contract is $160,000, leaving the futures trader responsible for another $154,500. But how would a trader lose more money than they have in their account? Here are just a few cases. Case 1, the gold market goes limit up or down against your position for multiple days. We will discuss this rare event later in this course. Case 2, you're trading in a contract after FND and the exchange assigns a delivery to you, requiring you to come up with the full value of the contract at somewhere to put the commodity. Case 3, a very unusual event happens during the less liquid time of the trading session and the market gaps over your stop. I tell you about this because it relates to getting out of contracts in a timely manner, or else you could face some of the mentioned issues. Futures brokers will do their best to keep their clients from losing more money than they have in their accounts. But we cannot rely on them in case they get busy or distracted and overlook our positions. In the end, we are each responsible for our own successes and failures. To keep from getting a commodity assigned to you, the exchanges created FNDs. Some FNDs come days before the contract actually expires, and others come the day after the contract expires. The ones that come prior to expiration, like in gold for instance, are the ones you need to be aware of. Most brokerage firms, like TradeStation, will use pop-up messages on your platform screen to advise you of FNDs, but again, nothing to rely on. Prior to FNDs, the exchange does not mind having speculators in that contract month. They actually like it because speculators provide liquidity for their larger commercial customers. What the exchanges do not want is to have speculators in the expiring contract too close to the last trading days. On the LTD of a contract, the exchange wants to settle that contract and notify all the commercial traders the actual price they will get paid or will have to pay for that physical commodity. If the exchange were to allow speculators to remain in the market up to the last day, there would be potential for defaults on contracts by undercapitalized speculators, thereby delaying the actual contract settlement price on the LTD. From FND to the LTD, the only market participants in the expiring contract will be commercial traders. If you're holding a position in a futures contract on FND and you wish to maintain that bullish or bearish position, you will be required to roll over your position. Your broker cannot do this for you without the power of attorney. They can take you out of a position if they feel there is monetary risk to you or the brokerage firm, but they cannot legally put you in a new position. Let's say you were long GCM 17 and tomorrow is May 31st F&D for the June contract. As per your analysis, gold will continue to go higher for several months. Maybe you have been in this position for several weeks and you have amassed a sizable profit. By close of business of the F&D, you will have to liquidate your long June gold contract. All of the profits you had will be placed in your trading account as closed out profits. Now you will need to buy another contract of gold to maintain your bullish view of this market. The next month in the gold cycle is August GCQ 17. Once you have closed out your long June gold contract, you could buy an August gold contract at the market. Then set your protective stop and profit target for this contract. Or you could look for demand level nearby the current price in the August gold contract and place a set and forget order to buy. The prices are usually different from one contract month to the next, but fortunately all traders have to trade the new price just like you do. This new long August gold contract can be held until your profit objective is reached, your protective stop is hit, or until F&D for the August gold contract, at which time you will have to roll over again to another contract month if you wish to stay long the gold market. Here's life cycle scenario 2. There are some commodity futures contracts where the F&D comes after the LTD, like natural gas. This is done to allow the company dealing with the delivery process to know the contract expiration settled price. There will be a fixed price for all involved to deal with, unlike a contract that has F&D before the LTD, where those participants will not know exactly what they will pay or get paid until the LTD contract settled price. Make sure you close your position and roll over to the next contract month before LTD. Let's say you were short NGN 17 and tomorrow is June 28th LTD for the July contract. As per your analysis, natural gas will continue to go lower for several weeks. By close of business of the LTD, you will have to liquidate your short July natural gas contract. Now you will need to sell short another contract of natural gas to maintain your bearish view of this market. The next month in the natural gas cycle is August NGQ17. Once you have closed out your short July natural gas contract, you could short an August natural gas contract at the market. For these markets, the way how we calculate rollover days is a bit flawed. For these markets, a trader needs to look back a few contract expirations. Find the LTD of the market you're tracking, then open an intraday chart of any time frame and observe the volume for each trading day coming into LTD. You will notice that each commodity futures contract will show the volume drop of one contract, and the next day, the next month out will have all the volume. By looking at a few of the previous expirations, you will see a pattern of the number of days this occurs before the LTD. Again, plan on there being a 1 or 2 day variance. Also, some markets, like the energy sector, have contract expirations every 20 trading days approximately. Rolling over positions every 20 days could be more hassle than it is worth. Plus, for every rollover you do, there are new commissions to pay per contract on the new positions. To eliminate the frequency of rollovers, longer-term traders tend to trade in back month away from the nearby front month. For example, energy traders could focus on trading in the March, June, September and December contracts instead of every month of the year. This way you can reduce your rollovers to 4 times per year instead of 12 times. Grain traders usually like to trade in distant months as well, so they are not involved with rollovers. Unlike the financial futures, the physical commodity futures have more volume in back month contracts to provide sufficient liquidity. Last but not least, life cycle scenario 3. The S&P 500, for obvious reason, cannot be physically delivered. For this reason, the exchange uses a cash settlement process. Cash settled futures markets don't have a F&D. Here you just close your position and roll over in case you want to roll over before LTD. Let's say you were long ESM 17 and tomorrow is June 16th, LTD for the June contract. As per your analysis, the S&P 500 will continue to go higher for several months. By close of business of the LTD, you will have to liquidate your long June S&P 500 contract. Now you will need to buy another contract of the S&P 500 to maintain your bullish view of this market. The next month in the S&P 500 cycle is September, ESU 17. Once you have closed out your long June S&P 500 contract, you could buy a September S&P 500 contract at the market. So that's it for this lesson. In the next lesson, I will introduce you to our futures cheat sheet where we compiled all the necessary contract data for you. This will become your daily handy guide trading futures. So stay tuned for lesson 6.